Hi.
And
Can I start? Can I start? Okay. Is it too tight? Okay. All right. No, it's not uncomfortable to sit right down. Okay.
Would you like this chair?
No.
Okay.
Here we go.
As a young man, heard the sky's the limit. First thing first, I'ma break through the ceiling. One life jam, but it feels infinite. One life damn, then I better go get it.
This podcast is being brought to you by the Reyes Group at IA Private Wealth. That is made up of myself, John Reyes, a wealth advisor, and Jillian Seguin, an associate wealth advisor.
Hello, everyone. Welcome to a Bearable Conversation with John and Jill. I'm Jillian Seguin, associate wealth advisor at IA Private Wealth with the Reyes Group. And I'd like to introduce to you our esteemed guest today and a partner that we work with very often. Go ahead.
I'm Eric Chen, ERC Wealth Management. I'm a certified financial planner, and I help the Reyes Group and their clients developing estate plans.
Okay, that's all that's important for this podcast.
Hi. My name's on the door. I'm John Reyes from Reyes Group. I'm a wealth advisor at IA Private Wealth.
Thank you. So today we are going to be talking about financial planning as an extension of an investment strategy, and also insurance as a very important planning tool in your financial success. Let's call it that, and how maybe to think of it differently than you're conditioned to view insurance, or how you would incorporate it into your finances. I think, thank you very much for joining us today, and thank you for working with us. We're very fortunate to have come across you just since moving over to IA Private Wealth, and certainly in the limited number of months that we've been here, the value and the guidance that you have offered our team has been, I think, transformational, and I think, wow. But you know who we are by now, because you're able to agree to come on this podcast, and you know what you're going to be facing. So, I guess where to start? I would probably ask you to comment maybe on where I started that conversation going, is how can we view insurance as part of a financial planning, and what it can mean to an individual in terms of their financial success?
Yeah, so I think there's a couple ways to look at insurance. Most people typically think about it as protection. That's usually the most common way, right? Eliminate your mortgage, debt, any debts outstanding, leave some funds for your family. However, there are other ways to utilize it as an asset as well. I would say part of that is from a liquidity standpoint. So it's not really easy. You might have lots of assets, but it's not easy to convert real estate into cash.
Yeah.
So if you have an insurance policy there, it's like an asset. Something happens, usually within typically about 2 weeks from the unfortunate circumstance, that family can have cash in their bank account to do what they need to do with for the loss of that individual.
Right. So thinking, okay, I've got my family set up, I've got equity in the home, I'll be okay, in the event that something happens. But then what's the housing market at that very moment? What does it cost to sell that house, from employing a realtor and doing all the advertising? And then also, how long does it take to sell that place, right?
I would actually, I'd go one step further and just simply say, we're assuming that we have a traumatic experience in this example. And when you think about it, you've just gone through a major shift, right? Whether it's losing a loved one like a mother or a father, if you're dealing, God forbid it's young kids, you're already dealing with a massive shift in the energy of that home. and now you're thinking of selling the home. Like, the last thing that they want to have is a displacement of their family unit when they really need to have some stability after a major event, right? And most of the things that we're discussing, I think, are very valid. Don't get me wrong, but I think that's the biggest part, right? And I think those are the things that people tend to forget about is, oh, on paper, I'm worth so much money, I'll just sell the home. Really? What if your wife's just passed away, or your husband, and your kids are looking at you for some stability? You're not going to want to sell the home.
Right, or I'll just sell my business, right?
Yeah,
I'll sell my
right.
business. I'll take the capital I have out of there, and it'll fund my kids, education or
Ongoing.
So let's focus on that. When we talk about, a situation exactly like that, a spouse has passed away. Now the remaining spouse is forced to liquidate a house, and a life insurance policy will offer them the time or the ability to maintain that house and have the capital to continue on with what they're doing. You're looking at what we would call probably like a term insurance. So there are several types of insurance out there. Maybe you could explain to our listeners, what are the types of insurance and how would you use each of them?
Yeah, so term insurance is typically used for, it sounds like a specific term. You have a mortgage, you have something for a specific time period that you want to be dealt with. The other type is permanent insurance, and those are usually, as it sounds, for permanent issues that you're going to have. Most of that is final expense planning and for your estate for the liquidity component, right? The death and taxes is going to be there. It's always going to be there, and because it's a known, that provides some stability and certainty about where and what cash is going to be coming in at a specific time.
Okay, so let's go one step further, like what you said. So I don't know if anyone's heard the quote. I said that I was going to bring it to this podcast, but Benjamin Franklin.
And I know Eric actually he had it, and he was going to not give it the opportunity.
Benjamin Franklin once said, "There is nothing certain in this world." Don't quote me on the exact wording, but it was along the lines of, "There's nothing that can be certain in this world outside of death and taxes."
Correct.
So, insurance is really that, right? Solving death and taxes. How does insurance help an individual with taxes? I don't think of it that way.
Yeah, so most people don't think about insurance in the way, again, they think about it for eliminating debt, protecting family, but on a longer term basis, insurance is used for a lot of tax liquidity issues. Again, it all usually comes back to liquidity. So let's just, very simply, you have $1 million RSP here in Alberta. Somebody passes, that whole RSP is now taxable. So you're in the highest tax bracket, you're going to pay 40%, see you later 40,
So this is when an
$480,000.
RSP is not just going to a beneficiary, right?
Well,
so
yes,
if you're
correct.
a spouse, that RSP would flow to the spouse as long as
Correct.
they're designated as
Yeah.
beneficiary
Correct.
without any taxes,
Correct.
right?
There's your spousal rollover, yeah.
But whatever the capital gain that is appreciated on that spouse's RSP stays as it moves over to the spouse. So it doesn't eliminate. And so when there's a death of the second spouse and that RSP has to be completely sold,
Yep.
and then dispersed to their beneficiaries, being their children, their siblings, a charity, whatever they name, their estate. At that point, there is a deemed disposition of the entire account, and whatever the capital gain is for all of the investments in that RSP then have a tax liability, right? Okay, so sorry, I didn't mean to interrupt, but I just wanted to kind of clarify that.
Yeah, so based on that, staying with that example, if you have a $480,000 tax bill, then the question then becomes, how do you pay it?
Right.
So obviously the RSP can be liquidated and you can keep with the $520,000 remaining. That's great. It's a great asset. But if there's a less expensive way to solve that problem, would you consider it?
Yeah, and I would even add on to it to say that, a lot of what we're reflecting on, and this is a wonderful world of the hypotheticals that we're doing, where we can create any type of scenario we want. The reality is this is real life stuff that happens, and when parents or the the creators of wealth, as I'll call it, because it doesn't always have to be parents, a lot of times there's going to be this assumption that, well, that'll be the next generation's issue or the beneficiary's issue, and the reality is that, going back to our examples, if those beneficiaries are young, right, there's a lot more complexities to it, right? It's not just a simplicity of just sell it and go, right? I could even add another complexity. What if it isn't an RSP? It's actually shares in a business, and the business partner survives, right? You can't just go sell those shares and just say, well, give me my money, right? And that partner doesn't want to be in bed with 18, 19, 21-year-olds as their business partners. So there's so many different types of avenues that this can come down to, Eric. And I think what you're really trying to drive in is that insurance is a situation that can be used as an additional tool in your belt to be able to resolve these major events that happen that are not small in terms of dollars.
Absolutely.
Right?
Yeah. Yeah. It can be very simple as you want it, but it can be very complex, a very complex product as well.
Yeah. And at this point too, I'm going to also elaborate on this, is that you'll notice that Jill and I are speaking very openly about our these types of examples. Here's going to be some what I'll call regulation and insurance 101 terms of like licensing. Our primary focus of our business for Jillian and I is that we are fully licensed and regulatory in our roles as investment advisors and wealth advisors.
Wealth managers.
Wealth managers, thank you. But in addition, we have our insurance license. A lot of people don't know that. Even our own clients don't know that we have our insurance license. And so it has something for you to recognize that the complexities of this specific topic alone, for us who have our licenses, that did our education, that passed our courses, want to rely with somebody such as Eric, which this is what he does primarily for his living, right? And so for us, it's a demonstration of yet, even through the complexity of this and us and our knowledge, we still can't even touch the tip of the iceberg of what it is that you bring, which is why this, genesis of this idea was brought to the table, right? And I'm glad that it's you, because you demonstrate a very strong skill set that is, no disrespect, you're smart and you're intelligent and you've got all those parts, but you're relatable. Mm-hmm. And that's why I found that it was super important. And Jill and I made the decision to say, we need to do this, right? Because this is the first time we've interviewed somebody. And for you to be it is key. So I want you to lean on those, right? Some of those experiences aren't exactly with us. So can you give us some examples about, a complex situation without getting into too much detail about the math? I'm more worried, or not worried, I'm more concerned about wanting you to share the emotional side, the financial side, the emotional side about doing a plan that had a great result.
Yeah, I think there's several. Jill and I were actually talking about this yesterday, and there's one individual I'm dealing with in BC, and I started dealing with him. He was an IT consultant who worked for himself. He was probably, I think his late 40s at that time, and because he's working for himself, I talked to him about his disability, critical illness, because he had no benefit, no work coverage, which most people kind of rely on. And I pushed him to get a disability policy. And most people don't like disability because they think it's never going to happen to me. And then about 4 years after he purchased that policy and we implemented it, he was on a trip in Europe, found a lesion on the inside of his leg, which ended up to be cancerous. So he's been claiming on his policy for the last probably 5-6 years, $7,000 a month. He's written me many emails and says, thank you for talking to me about that. If it wasn't for that, I would not be financially where I am today, being able to live day to day, because I would have literally no income, lost my company, can't survive anymore.
That's incredible.
But you don't hear those stories, right? People don't come out and say, hey, I won the insurance game, I'm getting claimed.
Yeah.
You don't hear about those, but it happens every single day that some unfortunate situations happen. It gets paid out, and you don't hear those people coming to the table saying, look at me, I just got a payout from whatever kind of insurance coverage I was covered under.
Yeah. I don't know, Jill, if you want to add something to that.
I just want to say, I was going to move on to, I think that is such a poignant story, and I think that's real life. And if we could hear more of that, people would not view insurance the way they do. And I do want to talk about the stigma around insurance. But just going back to the types of insurance, I think people don't really think about insurance policies, or they don't want to pay into them because they think it's just basically, if they never call on it, flushing money down the toilets, and they don't see any benefit unless an unfortunate event happens like that. But there are insurance policies where you don't have to die to benefit or to get some kind of cash value out of them. Speaking candidly for myself, I'll touch on one because I know it very well, and then maybe you could talk about other ones, critical life insurance policies where you can, get a refund of your contribution. Well, I'll leave that with you, but I have insurance policies on my children. And a lot of people are thinking, oh my God, oh my gosh, that is so morbid. How could you take insurance policies out on your children? And I said, well, let me explain this to you. I took it out before they were 1 year old. Their premiums are like $100 a month. And this is for a $60,000 policy on each child. Why did I take it out? Not so I could get a death benefit. But the reason being is I can overfund, meaning I can pay more than I am required in order to maintain that level of life insurance. And then what happens is the extra amount that I put over the premium accrues in a cash portion of that insurance policy. And that cash portion is invested, which I want you to comment on as well. But again, we were talking on tax efficiencies. Not only is it insurance a good tool to pay for tax liabilities, but insurance policies are completely tax sheltered environments. So that cash portion of my children's policy will accrue in a tax sheltered environment. And then after 20 years of premium payments with the overfunding, that policy is paid for. Not another premium needs to be paid, and I can gift it to my children. I can gift it to them in the event that they are uninsurable. So God forbid something happens to my child, they have a disease, or, John's wife has diabetes, and there's a lot of concern around that. So God forbid something happens with my children, and they are now at an age where they want to buy insurance for themselves because they have a family, and they are uninsurable. Well, I have a policy that I've gifted them. And that $60,000 death benefit will continue to grow as well, as long as we don't touch that cash portion. Okay, that's the first reason. The second portion is, at any point, my child can cash out that cash portion of the policy and collapse the policy. And this is important to me because when we think about the cost of education and how it's increasing, when we think about the housing market and how so many children nowadays don't have any money. In fact, I read an article, I think it was a year ago, that the average gift that parents gave their children in order to put a down payment on their first home was like $180,000 in Canada. That was in the Globe and Mail. But the point is that this is a way that I can have sort of a sidebar investment that grows tax-free, that when my child may need some excess capital, whether for education, for a wedding, towards a down payment on a house, they can collapse that policy and they can take that cash portion out. There's a lot of opportunity there besides just that morbid thought you're taking life insurance for your children. It was a savings tool for me. So that's one that I can resonate with. Maybe you can comment on other ones.
I've done the exact same thing for my kids as well.
I did too, just so I don't feel left out.
You don't purchase.
But mine's better than all of theirs.
Yeah, you definitely don't do the planning for thinking morbid thoughts like that, but it's more intergenerational planning, right? And ultimately, when you set up something like that and those types of plans, it's the tax efficiencies of gifting funds to your children later on. But even forget about that. At the base of it all, it's the risk management. What if they're kids? We've all been there. Kids do silly things. What if something happened to that child, though? I guarantee we're not going back to work in 2 weeks. No. I guarantee you're not going to be back to work in 2 weeks. A lot of people say, we'll be fine. It doesn't happen that way. And that would probably be the biggest one. So you're guaranteeing, again, the certainty that they're insurable, that their planning can continue on should something happen to them prematurely. But then on top of that, like what you mentioned, it's like purchasing an asset. After 20 years, it's done. That thing will continue to grow, and it'll then eventually supplement and provide them with opportunities within the cash component. And if not, it then starts the intergenerational wealth planning, which they're not going to benefit from. It's actually your grandchildren should and if they get married in the future.
So you mean when I give that insurance policy to my daughter,
Correct.
and then she may not need it, she can designate her children as the beneficiaries of that policy, and then they will be the beneficiary of her death benefit.
Correct. So you've actually indirectly started planning for your grandchildren without knowing it now.
I hope it's my daughter. I really don't think my son should bring any more children into this world.
That's like
They
my
are
middle guy.
like it.
Yeah.
But anyway,
I'll only add this too, is that, to add to that about the intergenerational wealth transfer, this becomes a really good financial teaching tool, because for it to actually have that effect, if we were to look that far out generationally, is you can borrow against it, right? And so that way you're not having to consider a collapse, right? So as long as you have those really good educational discussions with your kids about, the importance of money and having wealth and transferring that wealth, they can maybe borrow it in their more kind of 25 to 45, as long as there's an objective or a goal to be able to pay that down. Now you've got a tool that can move on to the next generation, and then they teach their children how you borrow against it. But guess what? That generation is borrowing against a much greater large value.
yes.
And so on and on and on. So, those are the types of things that we want to focus on when we're creating the conversation around, you tried to touch on it, and I don't know if it's for this podcast or if we're going to have Eric back, but, that insurance isn't a dirty word, right? And so we want to, maybe we'll segregate that, or we'll separate that for a separate one, but that's the key thing, right? There's too many conversations around insurance being the standalone, ugly stepchild. And the reality is that it's integrated into the family, and as long as you can integrate it into the portfolio and integrate it into the discussion, you're going to really, find tremendous amounts of opportunity for your clients.
Well, if you think about it, even just in a different manner, though, I mean, you're accomplishing the same thing, right, as a tool. So let's say you hold any stock, BCE. You have that because you want to grow that as an asset. At some point, you're going to do something with it. So if you utilize insurance in the same manner, it's just a tool that's going to grow. At some point, you're going to utilize it. It just happens that it's not a stock, it's not a bond. It has the stigmatism of insurance behind it.
But it's just another tool. So
But that's exactly what it is.
Yeah.
That's exactly what it is.
We were talking about it as almost like an asset class, right? You have cash, fixed income, equities, maybe, and we heard a gal yesterday at a seminar that we were at, and she calls insurance her risk mitigation asset class, right?
Absolutely.
Because it has guarantees or at least a little bit more certainty around it versus buying an equity. Just to close out on the critical illness, there are optionality there where if you don't use it, it's not expiring like a term insurance. Maybe you can comment on that.
Yeah, so critical illness has the very same optionalities and options in term insurance. There's different types. There's your term, there's permanent, there's return of premium on that. So if you don't utilize it and you feel like you're one of the ones that will not get sick, you can actually get all your premiums back. So, I mean, you can set it up any which way you want, and you find we develop something that's going to be usable in the client's plan is really what it comes down to, because it's what the client feels comfortable with.
Yeah.
And for people who, again, say that, it's not going to happen to me. I had a cabinet maker that I dealt with, young guy. He started with me around 26 years old. That just started his cabinet making company. And I think it was about 10 years after, so he was about 36. This would have only been about 2-3 years ago. He called me and says, hey, what's this cover? Like, big three, cancer, stroke, heart attack. That's, 90+% of the claims. And he goes, okay, what's it take to make a claim? Like, okay, well, tell me more about the situation here.
Yeah.
He goes, well, I went in, I found a lump on my testicle. Like, interesting. Okay. Doesn't hurt. Let's file the claim and see what happens, because I don't know where that's going to go. So we filed it, and then about 4 months later, he got a $100,000 check. He calls me up. He goes, "Hey, that's not so bad. I just had to lose a testicle to get $100K." So,
well, folks,
Wow.
this has been brought to you by
No, that's
I don't even know where to go with this. And I live right on the edge of the line.
And
It's not funny.
It's not funny. When you lose balls, it's not funny.
it's definitely not funny. But I mean, there's another situation. A 36-year-old.
You couldn't have gone with the other situation right at
Yeah,
the get-go
that's-
there.
Let's go. Let's let him clean it up
Let's
here.
clean it up. Go ahead. We're going to teach
No,
you
I'm
this
good.
whole
This is
full
your
circle.
this is your podcast.
No, I'd like you to clean it up because I don't know how we're going to edit this out. So go.
Yeah, that's the story. There's nothing.
That's it. You're not going to give us an out?
No.
There's nothing more to that. He just said,
That's stuff.
Well,
Just
thank
use
you
the
very
touch.
much for your...
No. Okay.
But anyways, it happens.
Yes.
Again,
aside.
you don't hear those stories very often, and when you've been around as long as I have, you see all sorts of things happen in the background. And again, no one comes out and flaunts it and tells you that this is what happened.
And I think, and all jokes aside, I think the reality is it's just that, right? When we, I'm trying to keep coming up with these different types of thoughts about why is this insurance such a, like, how many times have we talked about this? We even talked about it yesterday where I'm like, we need to start advocating, I don't know if that's the right word, but making people understand that this is not an old man in a suit or an old woman in a suit, talking about insurance and,
Selling you a used car.
that's right. We're 40-somethings. I'm like, I think I'm hip. I think I know what's going on. I think I can hang with kids. The reality is that just because you don't have to be old and stuffy to be able to understand and appreciate the importance of insurance as a tool, right? And that's going to be the advocating that I want. That's why when I look around what we're trying to do, what we're trying to build, stories like that are real. And you're right. Nobody wants to talk about it. Well, let's talk about it, right? So I'm really, really glad that you brought it up. Yeah, it shocked me a little bit because I didn't think you were going to go there. But, it is life. That's life.
Yep.
Well,
Life is not pretty sometimes.
when we made the commitment to be wealth managers, right?
Yeah.
One of my earlier podcasts, or one of our earlier podcasts, I talk about being a stockbroker, then an investment advisor, and then sort of the iterations we've gone through to get to wealth management. There's a reason why wealth managers are getting their insurance license.
Yeah.
Because they view it as important as the investment advice that we give you and the strategies. This is as important, if not, more important than being part of the whole comprehensive wealth strategy.
If you have a financial plan, it should be a component of
100%.
for sure.
And full disclosure, because again, that's just how I am. Jill and I have had our insurance licenses going back to like 2008-9. Like, this is not something, it's trendy to be a wealth advisor, and so we better go and get it and make sure we have all of our credentials, right, for the credibility. This has been part of the process for a very, very long time. What we have been up against has been the stigma of that. And I know that I'm now sounding more like a broken record, but this is why having this new forum, having this ability to talk to people at the masses is, I believe, a gift to us and our ability to be able to start to try to break that down little by little. And I'm really glad that we have you on board and working with our clients. I think it's going to be a tremendous benefit.
Looking forward to it.
Well, thank you so much, Eric, for
Thanks for having me
spending this
on.
time with us. And for those of you who do have any questions or want to speak to Eric directly, just give us a call and we'll connect you. Or you can find our contact information in the links below, I'm sure. Somebody smarter than me will put those links in. And this has been another Bearable conversation with John and Jill, and we'll see you next time.
Bye.
As a young man, heard the sky's the limit. First thing first, I'ma break through the ceiling. One life jam, but it feels infinite. One life jam, then I better go.
This information has been prepared by John Reyes, Wealth Advisor, and Jillian Seguin, Associate Wealth Advisor for IA Private Wealth Incorporated, and does not necessarily reflect the opinion of IA Private Wealth. The information contained in this video comes from sources we believe reliable, but we cannot guarantee its accuracy or reliability. The opinions expressed are based on an analysis and interpretation dating from the date of publication and are subject to change without notice. Furthermore, they do not constitute an offer or solicitation to buy or sell any of the securities mentioned. The information contained herein may not apply to all types of investors. The wealth advisors can open accounts only in the provinces in which they are registered. IA Private Wealth Incorporated is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. IA Private Wealth is a trademark and business name under which IA Private Wealth Incorporated operates.